Do you think then that the market has priced in a jobs picture that looks even just initially like this and probably will get worse before it gets better?
Well, there's tentative evidence that markets are beginning to stabilize in light of the measures that we have seen over the last week. This is seen in prices, but also in measures of investor behavior. And as you just said, even after the record rise in the U.S. unemployment announced yesterday, with the jobless claims data, the market reaction was calm. This suggests, for the moment at least, that markets have faith that policymakers have done enough to get us through this, what will be a brutal but hopefully short-lived collapse in activity. The big question we have now is, and it will take time before we get evidence to that, is on how long is that pause going to take?
Yeah, that is the big question, isn't it? Because you used the term short-lived. Some central bankers had previously been saying temporary. It's difficult to know right now, though, Jorg, isn't it? I mean, somebody was characterising it yesterday as an economy that is either on or off. And right now we are switching economies off all over the world, and that is going to be something that we'll have to, even through the worst, after the worst has passed, it'll take time to restart.
Yeah, and so that's actually exactly the point. We use on purpose the word economic pause, which does imply that activities will resume again. So the big question is, how long is this pause going to last? And the duration of the pause does have multiple consequences. Let me name you the key three ones that we see. Obviously, the longer the pause lasts, the later the economic recovery can start. So there's going to be a parallel shift on the timeline. The second point is the longer the pause lasts, the deeper the economic hole will be. And the third, and that is the most worrying element for us, is the longer the pause lasts, the more difficult the restart will be, as certain market participants might be already insolvent or will have disappeared. And in an average recession, the U.S. equity markets typically fall 25% year over year. We are not far from getting there now, so we have almost discounted an average recession.